A wonderful afternoon to everyone, and thank you for joining us here at Sarwa. My name is Eamon Debre, Head of Wealth Advisory, and thank you for tuning in to Investing Bootcamp webinar. I'm joined by my colleague, Akshay Iyer, who's one of our wealth associates here on our team, and we just wanted to say, first of all, Ramadan Kareem, and thank you for joining us. Now, we want to just give it a couple of minutes for attendees to make their way through the door and join us for our webinars. But maybe in the meantime, let's introduce ourselves, shall we?
Yes, let's do it. Thank you very much for that, Eamon. And thank you everyone for joining today. Just a brief introduction to myself. My name is Akshay. As Eamon said, I'm one of the wealth associates on the team here at Sarwa. I actually have a background in banking as well as private wealth management. I started my career at the Canadian Imperial Bank of Commerce in Canada. That's also where I was educated. And following that, I worked for a British private wealth management company called AS International. And I've actually been with Sarwa for around 6 months now. I'm very passionate about what we're doing here in terms of democratizing investing and really bringing across, a flexible, transparent, low-cost platform to this region. I think I've always been really passionate about financial education, and especially in this region. And that's something that really drew me to Sarwa. But yeah, really looking forward to speaking, with all of you today and answering those questions in regards to the 4 rules of investing.
Amazing. Thank you for that, Akshay. And as I said, my name again is Eamon Debre. I manage the advisory business here at Sarwa, and I've been here for just a little over 1.5 years. It's been an amazing experience so far to lead such a, wonderful team here and a wonderful organization. I've spent over 11 years within the region, most of which with HSBC, working in the retail banking wealth management division. I've done also a couple of years in debt management or debt consulting, which is basically helping those who are in dire straits when it comes to their finances, helping them and assisting them with their challenges that they're facing with their financial obligations to institutions within the region, whether it be personal obligations or corporate obligations. And I spent further 10 years working for an organization called TD Canada Trust in my hometown of Toronto, Ontario. And, I'm a big advocate of financial planning, a big advocate of making your money work as hard as possible for you. And that's what we're going to be covering today. So today, we're going to be talking about the best practices to help you succeed from a financial perspective. Okay, and we've dubbed this webinar a deep dive into the rules of investing. And what we're going to do is we're going to take you through this journey of what best practices you should be putting into place to help you succeed. And along the way, if you have any questions that do come to mind, please don't hesitate to pop them right into the Q&A section on your Zoom. And what we'll do is we'll make sure to address them at the end of this session, but if also we might be able to pick them up along the way if we see some of those questions are relating to the topics that we're just talking about as well. Okay, so without further ado, shall we, Akshay?
Yeah, let's do it.
Absolutely. Okay, so now it's really important to kind of start off with some, some notices though. We're going to be talking about the best practices, something that every single individual, regardless of their financial circumstances, can apply. But anything that's more bespoke or more specific to your individual circumstances, I strongly advise you have a conversation either with your advisor or one of our advisors here at the company. And the reason being is your circumstances are going to be very unique to you. And we want to make sure you're receiving bespoke and very accurate advice on how you should, address that financial, question that you may have. And secondly, of course, it goes without saying that we don't have a crystal ball. So if you do have a question about what's going to happen tomorrow in the markets, I'm sorry to disappoint you. I will not know, and nor does anyone else until they've invented or discovered this magic crystal ball. We're all in the same boat at this point in time. So we can't tell the future. So now let's talk about, what is the need that Sarwa is trying to address within the region. And very simply, when our co-founders basically, stumbled upon this idea back in 2017, they realized that a lot of the investment solutions within this region tend to be either very expensive, tend to be very complicated to understand when it comes to terms and conditions, and also tend to be very inflexible, meaning that a lot of these products are, were created to keep you, locked in for a period of anywhere between 5, sometimes 10 years, and in some cases even 25 years. And as a result, they penalize you should you ever deviate from your, financial plan, which we don't really think it's a really fair approach when it comes to financial planning. We believe here at Sarwa that investing should be very cost effective. It should also be very easy to understand and transparent, where you know every single, terms and conditions in a very easy to understand manner. And lastly, it should be as flexible as possible to meet your needs as your circumstances change throughout your investment journey. And that's what the real proposition is at Sarwa. So as I said, the co-founders kind of discovered and understood that there is a need within the market. And there's also other things that they discovered. As a result of these barriers to entry, the majority of individuals in the UAE, and you would never think this, just from the fact that we're, operating or working or living in one of the, highest per capita, in income levels around the world. Well, the reality is much of that wealth is actually not being saved for any long-term purposes, okay? This research was done by this consultancy company called Mercer, and they identified that 61% of the people in the UAE had no long-term savings at all. So much of that money was actually being spent month after month. And in fact, they went a little bit further and they realized that for those individuals who actually were saving, they were saving the majority of that money in a very simple savings account and at times in a current account. Well, there's a big challenge when it comes to this, and it's a very startling statistic because if you think about it, we all have goals and ambitions. And unfortunately, those goals and ambitions tend to cost more over time, whether it be retirement, whether it be if we have children, we want to be able to save and subsidize their university needs, or whether it be maybe you want to buy the ideal dream home that you've been thinking about for many, many years. Unfortunately, life gets more expensive and those items get more expensive. And if you don't make your money work as hard as possible for you, then you're going to find yourself constantly running like, similar to the hamster wheel, just kind of constantly running in the same spot. So you do need to take action to make your money work as hard as possible for you. And the reason why things get expensive is due to this little thing called inflation, right? Probably heard about it, maybe in primary school, maybe in high school, or even in university, depending if you took finance classes, but it's a real thing. You may not see it, you may not feel it directly on a regular basis, but the reality is that inflation is that silent pickpocket that is taking money away from you year after year. And on average, inflation is between 2 and 3% per year. But as of late, you probably have been feeling the pinch a lot greater, especially in light of where the cost of living increases that have been happening all around, whether it be real estate, whether it be rentals, or whether it be food costs at the grocery store, it might be even just entertainment. Things are costing more today. And that means that if you have, for example, $1,000 today, and you sock it away in a current account for 10 years, the spending power of that $1,000 is actually really worth about $780 at that point in time. So it's an alarm bell. We need to do something. We need to make our money work as hard as possible for you. Now you might ask, okay, well, where do I start? What's the very first thing I should be doing? Well, to that point, what we recommend is start with having your foundation in place. Similar to when you're designing and building a house, you want to make sure your foundation is solid. And foundational when it comes to financial planning is having your emergency reserves set aside. And when we say emergency reserves, we're talking about having at least 3 to 6 months worth of living expenses set aside so that if an emergency does occur, you'll be able to rely on that emergency reserve to be able to pay for that unexpected expense. So this is foundational item number 1. Foundational item number 2 is about ensuring that your debt is under control. And now when we talk about debt, we're specifically talking about bad debt. We're talking about credit card balances that are carrying forward month after month. We're talking about overdraft balances. We're talking about personal loans. These items tend to eat into your net worth year after year. And unfortunately, we are operating in a region in which the interest rates are significantly higher than they are in other markets around the world. Now, Akshay and I have both worked in Canada, and it's a very competitive market where clients are very, very specific about identifying credit cards with a low annual percentage rate, amongst all the different institutions. So it's very normal for us to see credit cards that are hovering around the 18% mark per annum. Well, unfortunately, here in the UAE, your typical credit card is anywhere between 30 to 36% per annum in interest. That's quite considerable. That's eating into your net worth if you constantly have balances carrying forward month after month. So to that we say, If you are looking to start investing, foundational item number 2 is prioritize paying off your bad debt. Pay off those credit card balances first. Pay off the personal loans that are charging you double-digit interest rates year after year. Try to maybe consolidate all of your inefficient, expensive debt obligations into something a little bit more cost-effective, through a salary transfer loan. Or if you have equity in your home and you're a homeowner, why not maybe utilize some of that equity and tap into it to try to consolidate your debt? So this will be foundational item number 2. Now, foundational item number 3 is about putting a budget in place. And I can't stress as to how important this is, because building wealth is not something that you do overnight. It's something that you build year after year. And it's about good habits and good practices that lead you to success. And a really great budgeting tool that we like to use here at Sarwa, and what we like to recommend to a lot of our clients, is a 50-30-20 rule. This budgeting tool very, very basically identifies that you should try to limit your fixed expenses to be no greater than 50% of your gross monthly income. Okay, I repeat, you want to try to do your best to limit your fixed expenses, such as housing, your education expenses, groceries, healthcare, transport. You want to try to live within your means. And within your means, from this perspective, means try to limit your fixed expenses to be no greater than 50% of your gross monthly income. Then you focus on your discretionary needs, because at the end of the day, we also have to reward ourselves. We all work really hard. Many of us work multiple hours in a given day, greater than the 8 hours that we're expected to work. And so you do have to reward yourself, and that's okay. Make a budget for it. And to this, we say allocate a maximum of 30% of your gross monthly income towards entertainment, maybe some fun subscriptions, maybe some social club that you're a part of, whether it be holidays. Try to make a budget for this and stick to that budget. So at least that way, you're actually leaving yourself a little bit of room that you can actually allocate 20% of what's left over every single month towards your financial goals. Okay. Now, these are kind of the foundational items I'd like to start with before we actually get into best practice number 1. So it's about building that house with a strong foundation. Now you start building upon it for level 1, level 2, etc. So we're going to move on to best practice number 1, and that is the importance of starting now. Not tomorrow, not the week after or a month later, literally starting now. And I really hope at the end of this presentation that this excites and inspires some of you to actually take that first step, because it is really impactful, the importance of starting today. And why is that, right? Again, I'm going to take it back to maybe when you were in primary school, high school, or maybe even university, where you probably heard about compounding interest. Well, this is a real amazing feature when it comes to money. Even Albert Einstein, and he's a physicist, he doesn't deal with mathematical equations, he doesn't deal with finance, he deals with physics, right? And the theory of relativity. But yet he still acknowledges himself that compound interest is the 8th wonder of the world. Well, why is that? Why is this such an important variable when it comes to building your wealth? Well, the reason being is that compound interest allows you to make money on your money. I repeat, compound interest allows you to earn revenue on your revenue. And this is amazing, fact when it comes to compound interest. And to kind of illustrate this example of how impactful this is, here before you, I'm highlighting a chart that basically shows you that if you had an investment solution that will guarantee you 5% every year, like clockwork, for the next 30 years, but you're going to be given 2 options. Option 1 is going to be that every single year, I'm going to give you a 5% return on your investment, but you have to withdraw the returns. So in this example, if you had invested $10,000 and I award you 5%, at the end of the year, you've earned $500, and I'm going to mandate or require you to take that $500 and do whatever you want with it. Maybe go spend it on something, go enjoy it. But this is going to repeat year after year. Year 2, you earn $500. You're going to withdraw it and you're going to go spend it. Year 3, 4, 5, all the way up to year 30, you're going to be withdrawing your $500. Okay. Now, very, very big, simple question. If you continue down this path, at the end of the 30-year time period, you'll have accrued a total of $15,000. So 5% of $10,000 is basically what you're, 5% of $10,000, taking home $500, $500 multiplied by 30 years, that's $15,000 that you've taken home. How much principal are you going to have left over at the end of that term? I'll give everybody maybe a second to kind of think about it. You started with 10,000, you're taking your profits year after year. What are you going to have at the end of the 30 years? And for those of you who've already kind of thinking about that number, you'll have your principal back. You're just going to have your original $10,000. You've taken all the growth altogether, right? And your take home has been $15,000 during that period of time. Well, what if I gave you another option, right? Option 2, which is, why not consider taking this 5% and reinvesting it back into the principal? So you remember that 10,000 that you invested in year 1? Well, you earned $500. Why not reinvest that $500 back into the $10,000 in year 2? And whatever profit you generate from that in year 2, reinvest it again in year 3 and year 4. And like clockwork, keep doing the same thing. Well, interestingly, during that time period, what you're doing essentially is making money on your money. Your $500 that you've taken is the money that you've made. You're reinvesting it back into the principal, and now you're earning 5% on that total balance of $10,500 in year 2. When you go down this route, you actually accrue a total portfolio value of $40,000, of which $30,000 was just compounding interest. Amazing if you really think about it. Just by thinking long-term and starting as soon as possible and reinvesting your returns year after year, you actually tend to make a very significant dent into your financial goals. Now, I really like that example, but I want to kind of extrapolate on this a little bit more. Use some numbers that we typically see here at Sarwa from our clients who are starting their journey. And to kind of illustrate this, there's 2 colleagues, one of which is named Rina, one is named Gina. Rina is 35 years old and Gina is 25. And they're friends. They work at the same place as well. And they had a conversation at the water cooler, and they both agreed on putting some money away for their retirement. Okay, and the amount that they agreed upon to invest every single year was $5,000. So Rina is 35 years old, and typical retirement is around 65, right? So based on a 30-year investment horizon, she's managed to put away a principal contribution of $150,000. Gina is slightly younger. She's 10 years younger. She's managed to put away $5,000 a year as well for 40 years. And in this case, she managed to accumulate a principal contribution of $200,000, which is really impressive. I mean, they really committed to putting $5,000 a year away, which is really great that they committed to their focus and their goals towards their retirement. Now, when you look at the difference between how much money Gina put away and how much money Rina put away, that's only about $50,000. And probably most would say very negligible as far as the difference between the 2. Well, interestingly enough, remember, Gina's younger, right? Look at the impact it makes, the fact that Gina is actually going to be investing for a longer period of time than Rina. Rina managed to accumulate a total portfolio value based on the 7% return with compounding interest, a portfolio value of $508,325, which is still by far large, very impressive. That's a nice little nest egg that she managed to build up that she can utilize for her retirement needs. She's happy. Gina, same formula, same variables. The only difference is that she's been doing it longer, which is 10 years longer than Rina, because she started 10 years sooner than Rina. And as a result, that extra 10 years equates to be a $500,000 difference. She has a portfolio of $1,093,681. This is the power of starting as soon as possible and because of the benefits of compounding interest. Now, as I said, Akshay and I have been in the financial services industry for quite some time. We've helped many customers start their journey and managed many relationships along the journey. And one of the things that we hear quite often, and it's a repeating thing at all stages of our careers, we've heard this, is that some individuals are just genuinely very afraid of starting to invest. They're worried. They read what's happening in the newspaper, and the digital newspaper probably nowadays. I'm dating myself here. They're receiving notifications. They're hearing news from their friends about there's a war happening and the markets are shaky. And there's concerns about the Fed rates and etc. So all of these concerns sometimes really, hamper the ability for individuals to start, right? And starting is usually the hardest part. And to that, we say, to be quite honest with you, that the things that we're seeing today, whether it be at wars or market volatility, are not a new phenomenon when it comes to investing. This has actually been part and parcel of the investing journey for as long as you can look back. I present to you a chart that I'm highlighting on the screen right now, which is highlighting the S&P 500 price level that goes all the way back to 1927. And the S&P 500 is a very popular index that a lot of people kind of refer to. It's one of the largest indices that people kind of subscribe to and refer to. It's kind of a gauge of the top 500 companies within the US. So if you're thinking about your Amazons, if you're thinking about your Facebooks, you're thinking about your Berkshire Hathaway, that would be your S&P 500. The interesting thing when you start looking at this chart, this green line that's squiggling across over the decades, you go back to 1927, where we had the Wall Street crash around that period of time. We had the Great Depression that followed afterwards. We had World War II. And, you can't tell me there hasn't been, this isn't a very devastating war, that, had, the entire world basically in arms, right? You had the Korean War. You had the Russian, launch of Sputnik, for example. You had the Cuban Missile Crisis. You had the US leaving the gold standard in the 70s. You had the US economic recession in the 80s when oil prices were through the roof altogether. You had the Gulf War a few years later. We had the dot-com bubble. And I don't know, if all of the audience members were, of age to be able to understand the impact of what happened in the markets then, but it followed through a 10-year period within the US where the markets completely underperformed because companies like pets.com were being valued at multi-billions of dollars just on the name alone. They didn't even have a business plan, but it was, that was what was happening then. It was a dot-com hype altogether. And then the market crashed. Then we had the global financial panic in 2008 and 9. But interestingly, as you kind of just take a step back, take a more of a bird's eye view, you would have noticed that the S&P 500 had just continued to trend upwards during that period of time, right? In spite of all the volatility, in spite of all the negative sentiment that was in the market, in spite of all the significant events that have happened in the history of the world, the S&P 500 just trudged along. It just continued upwards. And this is why it's really important to kind of ignore the noise, ignore the fear, the doom and gloom, and just start. Because just by virtue of participating in the market, you will benefit from the upwards trajectory and the upward rise of valuations over that time period. Okay, so as a summary, just for best practice number one, and hopefully those of you at home are taking notes on this, be decisive. Look at your current financial circumstances and decide what needs to be prioritized. Do you have debt? Try to get rid of your debt. Do you have your emergency reserve set aside? You do, great job. Do you have a budget that you're following? Are you diligent about watching where your expenses are or where your money is going and what your expenses are every single month? If you've got all this taken care of, right now is the best time to invest. And this kind of leads perfectly onto rule number 2, which kind of talks about, well, okay, I'm with you, Eamon. I've had a conversation with you, I had a conversation with Akshay and members of your team. I'm ready. I'm geared up. I'm excited. I'm ready to start. What do I do next? And that's a very fair question, to be quite honest with you. It's a very fair question. And to that, we say, consider a diversified approach to your investments, okay? Well, why is that? Well, this gentleman by the name of Harry Markowitz, who's a Nobel Prize winner, basically created the concept of modern portfolio theory, which is something that's being applied across all financial institutions across the world, whether it be retail banking, wealth management firms, private banking. The idea is you do not want to put all of your eggs in one basket. You want to diversify and put your investments across many different baskets that are available to you. And I want to highlight why that is, okay? Because it's one thing just hearing it and accepting it for what it is, but it's important for you to understand it, because the more informed you are, the better investor you will become. So to this example, I want to show you, is a chart that highlights all the different asset classes and how they've performed over the last few years, okay? And when I say asset classes, I'm talking about small cap equities, okay? We're talking about maybe emerging market equities, okay? We're talking about real estate equities. We're talking about even cash in this example as well too. And you'll notice in this multicolored chart that if I go to the top left-hand corner in 2016, it says small cap, it's highlighted in baby blue. What this chart is telling you is in 2016, small cap stocks or equities, specifically US in this example, were the best performing asset class. If you had decided to invest in this entire market of small cap equities, you would have been up about 21.3%, which is pretty exciting. Hey, I did really well. I made 21% this year. That's amazing. My savings account's giving me like 0.2, so I'm well ahead. Well, if you had invested, let's just say in emerging markets, which is almost halfway down, you'd be at 11.6%. Still very respectable. It's an amazing return altogether. If you were in cash that year, which is at the very bottom of that chart, you wouldn't have really made anything. You would have earned 0.3%. So sitting in your savings account, considering inflation, you probably would have been negative at the end of the day anyhow, right? So, okay, fine. You get it, right? So let's just say you tried to repeat the same exercise in 2017. Said, I did really well in small cap stocks in 2016. I'm going to do the same thing. I'm going to double down and take all my profits and my principal, and I'm going to do the same thing in 2017. Well, in 2017, small cap stocks weren't the belle of the ball. That wasn't the best performing asset class. In fact, emerging market stocks were. But small cap still did well. Don't get me wrong. Like it did decent. So you'd be pretty happy with a 14.7% return, right? And cash, no surprise, had a 1% return by the end of the year. Well, let's look at 2018. Imagine then you said, okay, I did really well in small cap in 2016 and emerging markets did really well in 2017. I'm going to mix it up. I'm going to mix the two together and I'm going to invest in both in 2018. Surely I'm going to do amazing. Fortunately, that wasn't the case. In fact, in 2018, emerging markets were the worst performing asset class. And small caps were not far behind at negative 11% towards the bottom of the chart, as you can see. And cash, surprisingly, if you were just sitting in cash that year, you would have been, king of the castle. You would have had a 2% return. And this goes to show you that trying to pick one particular asset class or one particular sector or one particular geographic region, trying to just isolate and concentrate your investments to one specific area is a very risky approach to investing. What you want to do is you want to diversify amongst many different asset classes so that you get the benefit of reducing your overall risk, but still giving you the potential of sustainable long-term growth within your portfolio. At the end of the day, the aggregate returns from all of these pluses and minuses tend to give you a positive return over the long term. And that's what you want to aspire to, okay? Now, a great way to do that, and just forgive me because it's getting a little bit dark and I want to turn on my lights here. And I forgot to turn them on earlier. Just bear with me, folks. You want to take this one actually in the meantime while I just turn on the lights?
Yeah, of course, no worries at all. And yeah, look, guys, in terms of that and how we actually are able to, employ a diversified approach is actually through something called an ETF. And an ETF is actually what's called an exchange traded fund. And simply put, it's actually just a basket of different securities bundled up into one product. So a really good example of how an ETF works is, let's say you want to buy one share of Amazon. Right now, one share of Amazon trades for a few $1,000s. And if you put a few $1,000s into that one share of Amazon, you're putting yourself in a kind of a tricky position because it's one specific technology company in America. So you're not being able to diversify from a sector point of view. You're not being able to diversify from an asset class point of view, or even a geographical region point of view. So what an ETF is actually, it's the ability to buy fractional shares of companies all bundled up into this one product. So, with $5, let's say, you're actually able to buy into thousands of different companies by buying into fractional shares. And that's a really good way to actually cheaply buy, thousands of different companies from around the world, regardless of sector, asset class, and geographical region. And that's a really good way to diversify. And that's what we kind of opt for at Sarwa.
Absolutely. I mean, look, there's two examples that we're highlighting here, right? So there's two ETFs, both of which we use in our portfolios here at Sarwa. The one on the left-hand side is VTI. It's the fund manager is Vanguard, and this particular ETF gives you exposure to the full market in the US, whether it be small cap, mid cap, or large cap companies. This gives you full broad market exposure. So it's, as opposed to just the S&P 500, which gives you exposure to the top 500, this particular ETF gives you access to over 4,137 companies operating within the US. So if you want to talk about diversification, you don't get any more diversified than that when it comes to the US market. And look at, if you go, a little bit more granular, you'll have exposure to healthcare. You'll have exposure to technology, industrials, telecommunication, oil and gas, utilities, consumer goods, consumer services. Every industry that's operating within the US that's publicly listed, you will have exposure to. And that's one of the beauties of utilizing an ETF, because it allows you to diversify, as Akshay said, in a very cost-effective and in a very easy manner. And just looking up the Amazon price, it's right on spot. It's about $3,170.83 as of right now. Oh, it just changed really quickly as well. That's to buy one share of Amazon. Well, guess what? With that same $3,000, you can actually buy over 4,137 companies available through the US. That's the beauty of it. Now, the other ETF that you see is actually it's a similar approach when it comes to sector exposure. You'll have exposure to technology, healthcare, consumer staples, etc. But this takes it one step further, because this is a developed market ETF hosted or provided by iShares BlackRock. And what this allows you to do is to diversify amongst many different countries, not just sectors, but different countries. So you'll have exposure to Japan, to the United Kingdom, Switzerland, France, Australia, Netherlands, Sweden, you name it. Any developed market or developed market nation will be exposed or will be included within this portfolio. So it's a great way to diversify not only across sectors, not only across different sectors, but also across different countries as well. Now,
yeah. So, Eamon, sorry to interrupt. I just wanted to quickly highlight something since we're actually on the topic of diversification. We've got a really good question actually from somebody, Aliyu, who's asked a question. Could you speak on how investments in Sarwa take this diversification into account? I think that's something we're going to cover later, but I think if you have any insights, whilst we're on the topic of diversification, that would be quite handy.
If I understand the question, is it more or less how do we apply diversification? Yeah,
exactly.
Absolutely. So when you go through our online journey, we're going to ask you a set of questions to get to know a little bit more about you. And these questions are really important for us because it helps us to understand what your goals, your ambitions, your investment preferences, your timeline for your investments, and also your appetite for risk. And all of these variables basically are computed to give you a recommendation on which risk profile that you should be entering into. And secondly, which portfolio aligns with that risk profile, okay? For example, we might have individuals who have gone through the journey and it's been identified that they really prefer a more conservative approach for their investments. Maybe they have a very short-term goal, or maybe not so much on the timeline, but they're just very apprehensive when it comes to volatility. They may find that their recommendation is heavily, heavily on a fixed income portfolio. So here you have your bonds, your all investment grade bonds is what will make up that portfolio. Whereas an individual who has a long-term view, has an appetite for risk, is comfortable, taking the long-term view and comfortable going through the ride, you'll see them having a more of a equity-based portfolio. Now, regardless of which portfolio recommendation you receive, diversification is really important. And the way we approach that is that you'll have ETFs that have exposure to US markets, emerging markets, developed markets, and depending on which portfolio you have, you might have extra specialization in real estate ETF. If it's a halal portfolio, for example, it might be gold. This is kind of examples, but all across the board, the ETF portfolios, the recommendation that you will have will be globally diversified. Hopefully that answers that question.
Yeah, perfect. Thank you so much for that.
Most welcome. So to kind of take it a little bit further, so the strategy and the methodology that we apply, here at Sarwa is really more of a passive investment strategy. And the whole idea is just about spreading your risk while trying to preserve your returns. And what we do is actually once we give you the recommendation, you start investing, is that we buy good quality assets, diversify, and we take a strategy of buy, hold, and rebalance at the appropriate time to make sure that your money is allocated in the correct fashion in line with your risk profile, and also to reinvest your dividends for you automatically on an ongoing basis, going back to the first slide, which is letting your money make money. So that's what we do for you at Sarwa, and this is considered to be passive investing. And for majority of investors who take this approach, whether it's on a DIY basis or whether it's through us, the investment experience tends to be very much Zen-like. And why that is because it's one of those strategies in which you just set it and forget it and check in from time to time to make sure you're rebalancing it and reinvesting your dividend. But for the most part, it's on auto drive. There isn't much effort that you have to put, or in case with Sarwa, if you allow us to manage your portfolio for you, is that you have no work to do beyond just funding the account. Now, the opposite of passive investing is active management or active trading, okay? And this is where you as an investor are behind the driver's seat and you are picking and choosing what you want to invest, when you want to execute that trade to buy, or when you want to execute that trade to sell. And you're taking more of a speculative short-term approach to investing, because what you're hoping to achieve is alpha. You're hoping to achieve positive returns and as quick as possible, right? Now, this could be either done on a DIY basis, or you may actually invest in funds that are managed by a portfolio manager who is making those decisions on a day-to-day basis for you. If you've ever heard the term mutual funds, that's exactly what they are. They are actively managed funds. There's a portfolio manager and a portfolio management team who's making a decision on a day-to-day basis on which markets to exit and enter, which strategies to take, what hedging that they should be doing. And that's what active management is. Now, statistically speaking, right? At the end of the day, you have to look at what works best for you, but you also have to look at the numbers as far as what has worked for the majority of individuals. And historically, actively managed portfolios have actually lagged in performance in comparison to the benchmarks that they're being compared to. For example, if you have an actively managed portfolio of, that's basically meant to mirror the US market, right? The S&P 500 alone, that benchmark itself, 90% of actively managed portfolios are not able to beat that. Just fathom that idea. 90% of actively managed funds, and this is not just including mutual funds, but this also includes hedge funds, which arguably have, probably the creme de la creme of the most educated, most experienced traders that you can think of. 90% of them are not even able to meet, let alone beat, the index itself. So as a result, you have to kind of take things into stock, is that if you're going to enter into an active trading strategy, you have to acknowledge a few things. Number one, it's not as simple as buying low and selling high. It's more often than not, it's actually very difficult to achieve this on a consistent basis. Number two, the information that you're going to try to utilize to trade, more often than not, is already stale news. It's already been priced into the market. So by the time that you've read it, it's already yesterday's news. It's already past tense. So that means everybody else is already aware of this and they've already executed their trades accordingly. And number three, the level of volatility that you will experience when you're actively trading is considerably higher than passive investing. As a result, your anxiety levels may be higher than you're able to cope with. Now, by no means are we saying do not go down the route of active trading. That's not what we're saying. We're saying is take stock and understand that there is a risk element when it comes to actively managing your own portfolio or utilizing active managers for your funds, and that you just have to be acknowledging and cognizant of this so that you can devise a strategy. Because at the end of the day, there's always strategies, right? And one of the strategies that we like to highlight, which has worked very well for many individuals, and it's actually a core principle of financial planning, is something called core and satellite. And I promise you that this is my last slide, so I'll hand it over to Akshay right after, who will take it from here. But this is a very effective strategy if you're going to be managing your own investment. And that is, you allocate the core parts of your overall portfolio to a passively managed investment strategy. put it into a set it and forget it, invest in a diversified pool of ETFs, and just let it go on auto drive. This is money you can't afford to take a risk on, or a considerable risk on. This is money that you need, not want, you need for a rainy day, whether it be your retirement or your home purchase or your children's education needs. And you want to make your money work as hard as possible for you, but in a very systematic way. Allocate the core parts of your portfolio in a passively managed investment strategy. Satellite, just think about it visually. You've got Earth and you've got the satellite that's kind of hovering all around it. Allocate a smaller portion of your overall net worth towards an investment strategy that is actively managed, whether it be you're doing it yourself or in an actively managed fund. At least that way, you're practicing risk management and you're limiting your exposure of your overall net worth to something which is very difficult and very emotional to try to control. And as a general percentage, we would recommend 80% towards core and 20% towards satellite. And on that note, I'll hand it over to Akshay, who's going to take us through the remaining 2 rules. So if there's anybody who wants to do a quick stretch before we jump on to the next topic, please feel free to do it now.
Perfect. Thank you so much, Eamon, for those 2 first rules. And yeah, everyone, thank you so much for the questions so far. We're going to answer all of them towards the end, and please keep them coming. Yeah, so I'm going to cover the next 2 rules. And the first of those are lower your costs. So this is actually something that we are very passionate about at Sarwa, because it's actually one of the few things that you can control when you're investing. Got the quote up here. So it's high fees erode returns, so lower your costs. That, it's as simple as that. So the higher the fees that you pay, the larger impact this has on your returns. And then I mentioned just before, the one thing that you can control is costs. When you invest in the capital markets, the one thing that you can't control is the return that you're going to get. There's a lot of large forces, at power that impact markets. That's geopolitical forces, social forces, economic forces, just so many things that are going on. So if you can control your costs, it's a really good idea to start with there. So you're going to find, when you start looking into this investment world and you start delving into costs a little bit more, you'll find that there are different types of investments that actually have different fees associated with them. And I think it's really important to get to know exactly what you're paying for. Transparency and simplicity is actually the most important thing when it comes to paying your fees. The investment provider, that you're working with should really be able to clearly illustrate the fees that you're paying. And normally, if there is any ambiguity with that, it's a really good indication to actually steer clear. I think, look, more often than not, and especially in this region, it's actually a very common issue. I think, from first appearances, when you speak to an investment provider, everything might seem very cheap and clear and concise, and it's a dream come true. And they often advertise for free or bare minimum fees. But actually, when you look at under the bonnet, there's a lot of different fees that are involved, and they're often written in small print. And we have this column here that says look out for, that's your expense ratios, trading costs, commissions, entry and exit, withdrawals, collections. There's so many more than that. There's commission kickbacks and this and that. And I'm sure if you've been in the region for a while, you would have heard these terms. And in the world that we live in 2022, there's absolutely no reason for you to have to pay any of these things. And often the problem is, it comes to regulation, but it also comes to, the way that some of these salespeople are incentivized. It's actually a commission base. So their main goal is to actually sell you a product, gain a commission, and move on to the next person. And unfortunately, a lot of people in the UAE have been burned in the past. And this is why it's really important to try and work with a fee-based firm whose interests actually align with yours, as opposed to a commission-based advisor. So over here, we're going to be looking at a hypothetical scenario that actually paints a picture on the importance of investment costs. So investment costs actually might not seem like a huge deal, but it's something that adds up. We talked about compound interest before, and investment costs actually compound along with your investment returns. So in other words, you're not just losing the tiny amount of fees that you pay, you also lose all the growth that the money might have had for years into the future. So a really good example of this, and an illustrative example of this, is this chart over here. If you look to the bar on the left, imagine you have invested $10,000, let's say. If that account earned 7% a year for the next 30 years, compounding over time, and had absolutely no costs, no fees, you'd actually end up with $76,000 in earnings. That's a great scenario. Look, that's not assuming any future contributions, anything like that. And look, perfect world scenario. But unfortunately, that doesn't really exist in the real world, and you always need to be paying something. And look, if you look on this on the right as a stark comparison, it illustrates if you pay 4.5% in fees on an annual basis. This seems extremely unreasonable. However, it is quite common in the UAE. And unfortunately, a lot of people don't even know that they're paying, fees that are this high. So if you'd invested, that same $10,000, after 30 years, you'd only actually have $21,000. So in this scenario, you're actually forfeiting over 50% of your profits to fees. And that's fees that are getting paid to a financial advisory firm. And if this is happening to you, this is when you want that advisor, that advisory firm to be driving you to work, washing your car, picking your kids up from school. Like that's really the sort of price that you should be paying, if it's coming to that. But look, on a serious note, if we look over to the next slide, I wanted to just really emphasize, what we've just been going over. We highlighted the difference between no fees and 4.5% in fees. In this scenario over here, we're going to look at the growth of 0.85% fee versus a 2% fee. And look, 0.85%, 2%, that doesn't seem like a huge difference in fees. It's actually a difference of 1.15% in additional fees. But what a lot of people don't take into account is the compounding effect of this fee. So every 5, 10, 15, 20, 30, 40, 50 years that you continue to pay the higher fee, this all compounds, So if you have the same investment return on that 0.85% versus that 2%, but that higher fee, with the 2%, you can actually end up paying, $300,000 over your lifetime in just advice fees. And I think only when you look at it, in such a stark comparison, I think that's when it's really easy to say, hey, look, I would much rather pay 0.85%. It is a lot cheaper. It makes my life a million times easier also. And look, I think that's really it when you're looking at fees. I think I want to leave you guys with just 3 takeaways. So look for transparency and make sure that you understand exactly what you're paying for when it comes to fees. Number 2 is if you are paying for advice, ensure that you're actually receiving a high level of service as well as advice. And finally, use 1% as a fee benchmark for your overall costs.
Actually, if I'm paying you $300,000, you're going to be doing more than driving my car. And I tell you that right now. Yeah, full-time chauffeur, full-time cook. That's what's going to happen. I'm not paying $300,000 for investment advice.
I couldn't agree more. Honestly, couldn't agree more. So look, guys, this is the last final rule, and we're going to jump into the questions as soon as we're done with this. And this is my favorite rule. It's all about behavioral finance and controlling your emotions. And I really think that this rule, this slide is what's really important, when the markets are volatile. And that's kind of what we're experiencing right now. And so when it comes to investing, it's really important to not let your emotions cloud your judgment. And so over here, we've got a quote by Peter Lynch. Peter Lynch is actually somebody who, a fund manager who managed the Magellan Fund at Fidelity Investments. And he's actually a huge proponent of value investing. And I think, this quote speaks volume of truth at this time. So it's far more money has been lost by investors trying to anticipate corrections than lost in the correction themselves. And this really emphasizes the importance of not trying to time the market and speculate on the market. So if we look at the next slide over here, this is, a re-emphasis of Peter Lynch's quote. There's basically a company called Morningstar that does a lot of investment research, and they did quite a well-renowned study that's known as the Mind the Gap study. And this actually looked into the investor returns and behavioral finance. What they did was they actually calculated the fund returns of a fund using asset-weighted calculations. And what the study showed is that over a 10-year period, which also included, the 2008 crisis, when equity, markets dropped over 50%, ending in 2017, the average fund investors underperformed the funds that they owned. In one example of a real fund, the fund itself actually returned 3.9% over that period of time, while investors actually experienced negative 15.4% of annualized returns. That's investors that simply didn't stay the course and their emotions took over. And that's actually why we call it a behavior gap. If an investor had just left their funds alone, stuck to their financial plan, they actually would have reaped reward. And that's why it's really tricky. When you actually are, I'd say, emotionally involved with your investments, they tend to get the better of you. And that's when you always tend to, unfortunately, make poor decisions in those times. So on this slide here, we've got a perfect illustration of what most investors actually go through. And this is actually quite representative also of business cycles, economic cycles, and just investor sentiment cycles. So, as an investor, a lot of people invest on emotion, but the two emotions that kind of dominate, investing is fear and greed. And, that's a big reason why people buy and sell equities. So unfortunately, a lot of people actually tend to buy when markets are high and sell when markets are low. And in an ideal world, you actually want to be doing the opposite of that, buying low and selling high. Often we hear in the media or from our friends, certain stock is performing incredibly well. We mentioned Amazon before. If you're Apple, Tesla, by the time you actually buy into this stock, it's actually reached an all-time high. And you've actually entered the market at what's called a point of maximum financial risk. And this is when you're tempted to buy more. Everything's been going good. You've bought that stock, it keeps going up, but then, that is the maximum financial risk. What tends to happen following that point is markets fall. And that's when the emotions come in. You start to question your decisions, you enter a sense of denial, that denial turns into panic. And then in the panic, unfortunately, that's when a lot of people end up selling their investments and actually realize a loss. But in reality, that time when the markets are so low is what's called the point of maximum financial opportunity, which you can see over there. So, I'm going to give you guys an example. And, we love to use this example at Sarwa. It is, if you've been eyeing this bag at Louis Vuitton and suddenly you go into the store, you see that this bag is on a discount. You're not actually going to wait for the price of that bag to go back to normal. You're going to buy the bag on discount. And it's quite nice to think about your investments that way. You want to try and obviously buy low and sell high. But obviously, I understand that's easier said than done, and our emotions can get the better of us. In reality, it is literally, almost impossible to consistently predict markets. And that's why it's really important to have a financial plan and just ride the wave. Regardless of what's happening in the market, if you have your plan, if the markets are, if you have a plan to, let's say, invest for your retirement, you're going to retire in 20 years from now, whatever happens in the market at that point in time doesn't actually matter. As long as your plan hasn't changed, you don't need to worry about the short-term volatility. Because when you look at history, you can always see the benefits of long-term investing. And yeah, on this slide here is just a big re-emphasis of why you really need to try and silence the noise. There's, as I said before, there's always going to be those external factors, whether that's, political, social, economic, that are impacting the markets in much larger ways than we can ever predict. It's really important to just focus on why you started investing. Focus on your financial goals, make sure that you have an investment strategy in place and try your best to stick with it. So try and disregard what's actually happening in the short term, because by the time you actually need that money, you won't even remember what was going on. So on this last slide, in terms of controlling your emotions, I just wanted to kind of leave you guys with this. So we've got 6 key things. So take a breath, don't panic, block out the noise, focus on your end goal, stop checking your portfolio, consider your risk level, and speak to your advisor. And out of those 6, there's 3 that I really want to kind of focus on. So that is stick to your plan. I just mentioned it, on the previous slide of how important it is to just stick to the plan, regardless of what's going on in the markets. And then also, if you don't need the money in the short term, don't worry what's actually happening in the short term. That has a lot to do with blocking out the noise. And, the third and my final one is to speak to your advisor. The whole point about a financial advisor is that they're actually there to help you. A huge part of Eamon and my job is to actually, help you, when it comes to behavioral coaching. It's a huge part of our role. It's my favorite part of the job is to speak to clients. So if you ever have concerns, if you ever have doubts, speak to your advisor and they can just re-emphasize the plan and the kind of the reason why you got started investing in the first place.
So what should we be doing then? In summary, actually.
Yeah, look, that's a really fair point. And, in summary, I just wanted to, really go over what we've just been talking about. So just to summarize that, our 4 rules. Number 1 is to start. You want to make sure that you're in the market, that you can start as soon as possible. The best time to invest, everyone says, was yesterday, but we can't settle for yesterday. We can do today. So start today. Number 2 is to diversify. We've talked about it previously. This is a huge thing. And it's a really, the Harry Markowitz term was, it's the free lunch in investing. It's a really key way to basically employ, Nobel Prize winning economic philosophy when it comes to actually, constructing a very efficient portfolio. So that's diversification. Number 3 is to control your cost. You want to make sure that you're paying as low as possible while still, maintaining and receiving a high level of service. And number 4, my favorite, is to block out the noise. Try not to be emotional, control those emotions. And if you do need to speak to a financial advisor, make sure that you speak to them. So that's really our four rules. But going into it, we wanted to, kind of discuss also, how does Sarwa apply these 4 rules and how is that effective? So when we look at it from a standpoint of Sarwa, with rule number 1, starting now, you can actually open your account completely online. So there's no need to go somewhere, in person. You don't need to sign documents and any of that stuff. It's as simple as downloading an app and you're good to go. You can start with as little as $5. So even if you don't have significant savings yet, at least you can start, that's your perfect way to just start at this point in time. Number 2, diversification. And, we had a couple of questions about this before, and I'll kind of just give you guys a kind of quick highlight of that. So with diversification and how Sarwa employs that, we actually create a personalized portfolio of ETFs for you based on your risks and objectives. These portfolios provide you with exposure to every major asset class, geography, as well as sector, and also employ Harry Markowitz's investment philosophy of modern portfolio theory that we discussed earlier. For rule number 3, and lowering your costs, our fees actually operate on a sliding scale from 0.5% to 0.85%, depending on how much you have invested. And that's it. It's capped at 0.85%. That's the only fee that you're going to be paying to Sarwa. There's absolutely no commissions, exit fees, trading fees, brokerages fees, nothing like that at all. Simple as the 0.85%. And number 4, in terms of controlling your emotions, I think it's really important to note, we actually have automated investments that take the emotions out of investing. That includes investment rebalancing, that includes, the portfolio construction itself, and then any dividend reinvesting also. So you as a client, all you need to do is deposit funds into the account, and that's it. We take care of the rest. It really is the definition of autopilot investing. And most importantly, we have an amazing team of customer excellence associates. We've got an advisory team, and we'd love to speak with you. As I said before, it's my favorite part of the job. So if you ever have questions, concerns, please don't hesitate to reach out. We are more than happy to help. And look, with that being said, I'm mindful that we're going a little bit over. So I think this would be a great opportunity for us to kind of stop talking and answer some questions.
Absolutely. Let's check into the Q&A section to see any questions. So Anonymous says how to begin. Let's start with your online journey. That's the best place to start. Whether you want to go on your computer and go to our website and register and go through the questionnaire, you'll receive your recommendation immediately, or you can download our app. And that way it'll allow you to be able to start the journey through your app as well. And you can finish your journey through either route. So I hope that answers your question for you, Anonymous. There's a question. Sorry, go ahead.
Sorry, and I think Anonymous also said how to begin with an ETF. So Anonymous, yeah, exactly what Eamon said. That's the same journey, and we actually employ ETFs as part of our Sarwa Invest portfolio. So you don't need to worry about anything in terms of picking those specific ETFs. Everything is taken care of, for you, basically by us.
Absolutely. There's a question here by Aliu about the historical performance. So Aliu, you can actually find our historical performance right on our homepage on our website. It gives you the historical performance, not only from the duration of when we were operating, but we back tested our strategy and our rebalancing all the way back to when these funds originated or when they first started, so for the same composition. So you'll see the historical returns. And just off the top of my head, you're looking at a range. If you're talking about our most conservative portfolio, which is predominantly fixed income, you're looking at an average of about 4% per annum on the fixed income portfolio. All the way to our most aggressive, you're looking at about 11.3% last check per annum as far as the net returns. So have a look, Ali. You can take a look at our website and you'll be able to see the historical returns across different risk profiles, different products that we have as well. And just for the audience, in case you weren't aware, we have 3 different portfolio types. We have a conventional portfolio, we have a halal portfolio, we also have a socially responsible portfolio, and they all have different returns accordingly. Okay.
Perfect. Thank you for that. I think we have a question here in the chat function. Question by Chris. So Chris has asked, what are the US tax implications when I cash in? Need to add that I am not a US citizen. Chris, perfect. Thank you so much for that question. Look, in terms of US taxes, tax is actually a lot to do. If you're not a US actual citizen, then that's something that you don't need to worry about in terms of tax. Tax is actually associated more with the jurisdiction that you reside in. So let's say, Chris, that you're in the UAE, for example. If you're in the UAE, there's actually no capital gains tax. So as a result of that, there's nothing that you need to worry about in terms of reporting tax whatsoever. We also make sure that with our Sarwa X product, the Sarwa Invest product, we actually shield you from what's called US estate taxes through the structure that's, basically through the omnibus structure and through our asset manager license. So everything is taken care of from a tax point of view. We make sure that everything is optimized, to basically work for you in regards to that.
There's a question here by Elias. He said, hi guys, thanks for the session. What's the name of the S&P 500 index in the trading section? So if I understand correctly, so you're talking about Sarwa Trade, and what's the name of the ETF? I believe it's what's the name of the S&P 500 index? So I'm assuming it's ETF is what it is talking about here. So there's a few options that you have when it comes to finding an ETF or a tracker fund when it comes to S&P 500. And I'm just going to itemize a few lists for you. So while you were talking, actually, I just kind of did a quick Google search because there's so many options. But the top one I'm going to highlight for you, Elias. So you've got IVV, which is provided by iShares BlackRock. That's an ETF that tracks the S&P 500. You've got the very famous VOO provided by Vanguard, which is talked about quite often because of its very low expense ratio. You also have SPY. That's another one that you can utilize to be able to track the S&P 500, and it's most notable for its liquidity and its volume. I mean, there's quite a number. There's SPLG. That's another one that you can utilize. So there's a number of them, Elias. What you can do is just go to the Sarwa Trade and just type in S&P 500, and you'll be able to find a list of different ETFs that you can utilize to start investing. Or worse than that, you can always just do a Google search and you'll be able to do a comparison to see, well, which ETF, what's the expense ratio, is there a tracking error, how much of a tracking error is there, so you can be able to do some analysis before you start investing. Otherwise, the Sarwa Invest portfolios are diversified globally, but of course, you'll have a component that's invested in the US as well.
Yeah, perfect. So I think we've got another question from Anonymous. So once I create my account, does someone from Sarwa reach out to me, or should I reach out to you guys if I need advice as a beginner?
I mean, you feel free to reach out to us. We don't bite, I promise you. Right? So, we're very flexible. So what normally happens as a part of your journey is it is automated, and it's meant to empower you to get started right away. So we don't want to make you reliant on having somebody reach out to you to engage you in conversation, because to be honest, we onboard thousands of clients every single month. It's a little bit difficult for us to proactively call each and every one, but we're available on a reverse. So if you ever want to reach out to us and you need guidance, you can either, number one, just go onto your WhatsApp and WhatsApp us directly. It goes to our customer support team who could be able to answer your questions for you right on the spot. If you need a little bit more of an in-depth discussion about how to start investing, looking at your current financial circumstances and giving you a recommendation, just make an appointment with one of our advisors. There's plenty of advisors available. You book an appointment in, you can either have a phone call or a video call, and they'll guide you through the journey.
Yeah, perfect. And just to add to that, I think I said it about 10 times in the presentation. It's our favorite part of the job is to speak with you guys. So if you have questions, please don't hesitate to reach out. We're more than happy to help.
On that note, we don't have any more questions.
Yeah.
I guess right on time per se. And Ramadan Kareem to everyone, and I really appreciate you guys joining us today. I know for those who are fasting, it's been very difficult to make it all the way to the end of this session, but we really appreciate it, and we hope to see you soon. And if you have any questions or any queries, don't hesitate to reach out to us. And we're really excited for you to start working towards your long-term goals. And if you need anything, Laura, pleasure is all ours. Thank you so much for the wishes. And have a wonderful evening, everyone.
Yeah, perfect. Thank you so much, Eamon. It's a pleasure. And everyone, thank you so much for joining. Really appreciate it. Please don't hesitate to reach out if you do have any questions, okay?
Have a good one. Thank you, Laura.
Thank you so much, guys. Take care. Thank you.